So now let's think a little bit more about some behavioral aspects of this decision. The first thing we talked about is something called the signaling theory. Modigliani and Miller, in their theories, assume that investors and managers have the same information. And of course, we know that's not true, right? Managers know more than the owners. I mean, think about a company like Disney that has 1.8 billion shares. Do all of those owners have the same information as the managers inside that company? And of course, I think you would say probably not. So when do people buy and sell stocks, right? If you think your stock is overpriced, you own a stock that has you paid $50 for it, right? But the rest of the world says, hey, now it's worth $60. And you think that is overvalued. That's too high. Well, you take advantage of the higher price and sell it now. So that likewise, that's what managers do. If they think the stock price is overvalued, they will sell it. Now, selling's the wrong term. Like the correct term is they would issue stock because they're getting more money than what they think the stock is actually worth. And of course, they would sell bonds when they thought the stock was undervalued, right? I mean, if you thought the stock was worth $50, right, but it's currently selling for it's undervalued, right? I mean, you wouldn't want to sell it at the lower price because now you think, well, I'm not getting all my money. I'm not getting what it's really worth. So in that case, if you needed money, you would then issue bonds. Of course, you and I understand this. So when we see stocks being issued, we see that as a negative signal. Managers are sending a sign, a signal. Now, what does that mean for managers? Maybe they want to send us a signal. Could be true, right? But this has implications for the decision making that they make. They want to take into consideration my behavior as an investor. So how do managers actually work? There's a theory referred to as the pecking order theory. And this was done through some research where they asked some CFOs, what things do you think about when you are considering gathering funds? What's the thought process? From that research, they basically came to this conclusion. Companies would rather use profits first than use because of higher flotation costs or negative signals. So they always want to use retained earnings to invest first. Makes sense. Companies want to use their profits to reinvest. If they need more money, though, they would rather issue debt first. Why? Lower flotation costs and equity, again, remember, has this negative signal. So it has lower costs and a positive signal possibly. And in the end, if they still need more money, then they would go out and issue equity. Now, one of the things that we haven't added in this slide for us to kind of think about is, where do retained earnings come from? This is the last couple of videos we talked about dividends. So dividends, how much we pay out, influences retained earnings. What about investment opportunities? If a company has a lot of investment opportunities, they're going to eat up their profits very quickly. So they're going to have to go to debt sooner than maybe other companies. So our decision on how much to borrow is influenced to a great extent about our investment opportunities for the corporation. We've mentioned off and on through some videos the idea of agency costs. Sometimes managers do things that are non-value maximizing, right? They do things that aren't good for the owners of the company. They do this because they have cash to play with. Since borrowing money decreases the free cash flow, companies that borrow a lot are looked at as being companies where there's probably very little perks or non-value added acquisitions going on. There's some limits on what you can spend, so you're going to be a little bit more of a little bit, maybe a better servant to your owners with respect to that. A second problem, agency problem, again, agency problems affect value, right, is the idea of underinvestment. Debt increases the risk of financial distress. We now know that's very expensive. So managers might avoid risky projects even if they have positive net present values. They don't want to take the risk because the risk ultimately leads to financial distress. Obviously leads to the end of their jobs most likely, but certainly a lot higher costs for the corporation. Managers may try to time the market when they're issuing securities. They might want to issue stock when the market is high and after some big stock price run-ups. They also want to issue debt when the market's low or when interest rates are low. Short-term debt, if it's kind of flat curve, a flat yield curve, they might want to use more short-term debt. The challenge with market timing is really twofold. One, nobody can time the market. Nothing can ever be done perfectly. There is a theory, though, that's called the efficient market hypothesis that basically says all the information that's available about a company is incorporated in its price. So whatever the price is, that is very close to the true value of the company. So when we say here the market is high or the stock price has run up, why has it run up? It's run up because the company is worth more. It's not an advantage to this financing question. So what kind of evidence do we have? Tax benefits are very important. They say here roughly an average firm that has 25 to 30% debt adds about 3 to 6% to their total value. Again, all of this research before the tax code change. But bankruptcies are very expensive. It can cost from anywhere to 10 to 20% of the value of the company. Firms typically have targets. We like to keep ourselves between 30 to 40% debt. That's their target. What happens if they get out of the target? Obviously, they'll try to make some arrangements. Not arrangements, so they make adjustments. But these adjustments can be very slow. On average, you only be able to make about a 30% correction per year, depending on the company. High cash flows, it could be 50%. If you have very high cash flows and you're above the target, you might want to be very quick. You want to make big changes. Why? Number one, you have the cash flow to make the changes, to pay off the debt. But if you're above the target, that means financial distress. Those costs are very high. What they tell us, again, from our research is that the value that you lose from being above the target is bigger than the lost value from being below the target. So once you get above the target, those financial distress costs rise very rapidly. Now, sometimes companies will deliberately go above the target. They'll do this to take advantage of some investment opportunity. This is what we refer to as a window of opportunity. After big price run-ups, the debt ratio is going to fall, but firms tend to still issue equity instead of debt. This is inconsistent with the trade-off model. It's inconsistent with the pecking order theory. However, again, it is very consistent with this idea of a window of opportunity. If you have opportunities, you want to take them now. You don't want to wait. Borrowing may be the way to take advantage of those opportunities. Having said that, what most companies will try to do is maintain some borrowing capacity. We need excess borrowing capacity to take advantage of those things. So as far as managers are concerned, then, they certainly know about the tax advantage, right? High tax companies that have high tax rates, stable sales, and low operating leverage, these companies like to have debt. Now, we know that some of this benefit is now reduced because of the new tax laws. Managers want to avoid financial distress. Their company has volatile sales, high operating leverage. They have a lot of potential investment opportunities. Or they maybe have what they refer to as special purpose assets, right? These are things that they have such a unique purpose, right? If they have lots of those, they're going to want to avoid financial distress, and they're going to want to maintain excess borrowing capacity, not have too much borrowing. Of course, in the end, if managers have asymmetric information, they're going to avoid issuing equity if the actual prospects are better than the market perceives. If we think it's a great idea, but they know it's not that great, they're not going to want to issue debt. And the final thing, of course, is, and we really haven't even mentioned these people to now, is what do our lenders think? What do the rating agencies think? We always want to consider how the change in capital structure will influence our rating agencies, right? How will that affect our rating from a AAA to a AA? Because as it affects those, that affects the costs of financing. See you in the next video.